This is stock analysis in 5 minutes or less. Today I'll be looking at Levi's. From the stock chart, we can see that Levi's has since recovered from its pandemic lows. The company was founded in 1853 and is known for its iconic brand of jeans, but has since diversified its product offerings. As with many apparel companies, the pandemic and lockdowns has hurt Levi's sales. For fiscal year 2020, its sales fell 23% and its operating income fell a whopping 115%. While the company suffered a net loss last year, we could see that they had a positive free cash flow. This is in large part due to Levi's incurring larger non-cash expenses and tightening of its credit policies. Because of the pandemic, there was a decrease in value of Levi's PP&E. As such, Levi's appropriately recorded an impairment loss. This represents a reduction in carrying value of Levi's assets and does not affect Levi's cash on hand. As the pandemic spread in the United States, Levi smartly tightened its credit policies. This means that they will receive customer payments sooner. In a year where many apparel companies have filed for bankruptcy, having a positive free cash flow is a good sign. This means Levi's operations can generate enough cash to meet its short-term liabilities and avoid potential bankruptcy. Levi's has a quick ratio of 1.38 for fiscal year 2020. This means that the company has more than enough liquid assets, meaning cash, marketable securities, and accounts receivables, to cover its current liabilities. Now let's look at its debt coming due within a year. This includes any borrowings, loans, and operating leases. I chose to include operating leases as debt because they're unavoidable like a loan. We can see that Levi's generated enough operating cash flow to cover its debt coming due twice over. It's also important to note that the company has a debt to equity ratio of 2.05. We generally want that number to be less than 0.5. The large number is due to Levi's issuing $500 million in long-term debt in the beginning of the pandemic. I'm okay with this decision. At the time, it was unclear how long the pandemic was going to last, and having the cash on hand helps keep their doors open for as long as possible. There was also an accounting change recently where companies have to start recording operating leases as a liability. Levi's is moving to opening its own stores, so I wouldn't be surprised in that number staying high, but I'm generally okay with this decision since it's just part of the business. This is where I see the company heading. As the economy recovers and businesses and offices start to reopen, I expect sales to return to pre-pandemic levels. Afterwards, Levi's growth lies in pursuing global growth and expanding its product offerings. I expect a small but steady growth in large part due to its iconic brand name. Its brand name will also help preserve its operating margins as the company expands. I performed a DCF model and valued the company at $23.59 per share. At the current trading price of $26.47, it is slightly overvalued by 12%. I would not be picking up any shares at this price, but I'll keep my mind on this company since a 10 to 20% fall wouldn't be unimaginable. Thank you for watching this video. Please let me know what you think about this company and where it is heading.